Welcome to my channel Accounts Accuracy, and here we are going to study depreciation. As you know, depreciation is the decline in the value of fixed assets, that is plant, machinery, motor vehicle, furniture, etc. I have already discussed about it in detail in my previous video. You must watch my first video of depreciation to understand it in detail. Today I will be discussing written down value method. Straight line method has already been discussed in the second video of depreciation. Let's study written down value method today with the sum. As you know, written down value method is also known as diminishing value method. Now, why is it called reducing installment method? That you would easily be able to understand if you will see it through this sum. Here, the sum says, a firm purchased on 1st April 2016 a second-hand machinery for 36,000 and spent 4,000 on its installation. Now, in this method, you have to remember that we keep on deteriorating the price of machine and we charge depreciation on the depreciated value of machine. That means not on the original value of machine, but after the reduction in the value of machine, it is calculated. That means after 1 year, whatever remains the value of machine, on that only the depreciation is calculated. That's why it is called diminishing value method. Now, in this question, it's been told that on 1st April 2016, a second hand machine for 36,000 was purchased. So for that, you have to remember that installation charge will also get added to it, because whenever any machine is purchased, the installation charge upon it also included in the capital investment. That's why the machine's value will become 40,000 instead of 36,000, because 36,000 was the value of machine and 4,000 installation charge got added, and the amount spent on the installation plus machine value has become 40,000. So amount which was paid for machine 1 was 40,000. So your entry would be 2016. You have to write here the year as well as the months and date, that is April 1st would be written, and to bank, that is machine 1 would be written with the amount 40,000 in the machinery account. Next to that, the other information which is given is that 1st October in the same year, another machinery costing 20,000 was purchased. So you can see here the second machine also got purchased, that was of 20,000. So again, the entry for the purchase will be written with the proper date, that is October 1st to bank, and that is machine 2, and then M2 means machine 2, and then 20,000. Now for both these machines in the year 2017 March 31st, that means after completion of 1 year from April 1st till 31st March, whole complete 1 year, after the completion of 1 year, the depreciation on both the machines would be provided as per use. Now here machine 1 has been used for the full year, that's why it will be provided 10% on 40,000, that would come 4,000. But the second machine, as you know, got purchased on 1st October, that means it's been used only for 6 months. So that's why depreciation would be provided only for 6 months. That means 20,000 into 6 by 12 into 10 by 100, that would come 1,000. So this 1,000 plus 4,000 makes 5,000, which would be written in the final column. Then balance will be calculated for both the machines separately. You can see here 40,000 was the original value of machine and 4,000 depreciation would be deducted, and now the value of machine at the end of the year would become 36,000. That means at the beginning of the second year 2017 April 1st, it would be 36,000. Again machine 2 also 20,000 was the original value, and as this got depreciated by 1,000, so now the value has become 19,000 in the year 2017 on 31st March after completion of 1 year. This would diagonally be brought to the next beginning of the next session in next assessment year. So that is why M2 and M1 balances of 31st March would be brought in the next year, and that would be 36,000 for machine 1 and M2, that is machine 2 19,000. Now we have to calculate depreciation on this depreciated value of machine, not on the original value of machine. So from now it would be calculated on 36,000 and 19,000 for the next assessment year. So the depreciation for the full year, as it is going to be used for whole year, that is from April to 31st March, it would be 10% of 36,000 is 3,600. So it would be 3,600 and 10% of 19,000 is 1,900. So both these depreciations would be written separately, and at the final column the additional value of both the depreciations would be written, that is 5500. Now again we have to calculate the balances of both the machines separately. So here you can see machine 1, that means from 36,000 again we will depreciate this 3600, that is 3,600, and the reduced value of machine would become 32,400. Again machine 2 value also from 19,000 we would deduct this depreciation, that is 1,900 for the year, and its value would become 17,100. Now these two values will diagonally be posted in the next year, that is 2018. Here we have to bring it diagonally as the balance for the third year. Now here in the question it's been also mentioned that machine bought on 1st October 2016 was sold. So remember, this machine which was purchased on 1st April 2016 got sold on the 1st October 2018 for 12,000. So the machine was of 36,000 and it got sold for 12,000. So here we have to calculate whether it got purchased for profit or loss. So now we have to see the value of machine after the deduction of 2 years depreciation was 32,400 and its original value was 40,000, but after the depreciation of 2 years its value has reduced to 32,400. Now from this again till October we need to provide depreciation because it was not sold on April 1st but it's been used till October 1st. The machine was used for 6 months. So definitely 6 months depreciation must be calculated and provided and must be deducted from it. So 1620, that means 32400 into 10 by 100 into 6 by 12, it would come 1620. So this amount of depreciation should also be deducted and the value of machine would be reduced by 1620. Now we also notice that 12,000 was received. So that's why we will deduct 12,000 also. Still what we are noticing, the value of machine was sold at loss because after deductions of these two values, that is 12,000 and 1620, sold at the loss of 18,780, which was not received on its sale. So this loss was suffered by the company. Now remember, first of all the depreciation will be deducted and after that we will deduct the value of the amount received on sale. Then it would easily be understood whether the machine got purchased on profit or loss. So here we are noticing that after reducing these two values, also this much balance was left, that is the balance of 18,780 was still left to be recovered. As it's not been recovered, that is the loss value of the machine. Now for other two machines, that is M2 machine 2, 17,100, we have to deduct the depreciation, that is 1,710 rupees because it was used for the full whole year. So 10% of 17,100 would be 1710, and again the third machine was purchased on 1st October. So this M3 we have to provide depreciation only for 6 months because it was purchased on 1st October and till 31st March it was used only for 6 months at the rate of 10% for 6 months. So the depreciation would be 64,000 into 10 by 100 into 6 by 12, which would come 3200. So this is the two values of depreciation on rest of the two machines. Now the total value of both the depreciation would be 4910, which would be written in final column, and at last you will calculate the balances of the rest two machines which was not sold, and that would be calculated by deducting from the balance the depreciated value. That means 17,100 minus 1,710, you would get 15,390. And when we deducted this 3200 from 64,000, we are getting the value 60,800. So these two are the balances left for the rest two machines. Machine 2 15,390 and machine 3 60,800. So that's all for today. I hope you might have understood the second method, that is diminishing value method. And if you like my video, please don't forget to subscribe my channel and hit the big fat like button. Thanks for watching.